Hi, I'm Assistant Professor Aditi Mathur, International Schools of Business Management, Suresh Kanvia University, Jaipur. And today we will learn about capital budgeting. This video lecture will not be focusing on any of the methods used for the capital budgeting, but this video lecture will help you out to develop the core understanding of what is capital budgeting all about. We will try to learn the concepts and the associated meaning topics related with the capital budgeting. So before we begin with understanding what is capital budgeting all about, let us just first understand what do we mean by financial appraisal. So financial appraisal views investment decisions from the perspectives of the organization. So as an organization, we take the decisions of investment in financial appraisal. It helps to assess the viability of the projects based on the direct effect on the cash flows of the organization. It considers whether the project revenues will be sufficient to cover the expenditure and whether the financial return is sufficient to make the investment commercially viable. That means your profitability. So, in the financial appraisal, as an organization, a manager decides whether to invest in that particular project or not, whether the revenues will be earned in that manner which we are predicting or not. So, in this, we try to compare the expenses, the revenues, the future risk to decide whether that particular project is viable or not, to consider it as a profitable project or not. So, financial appraisal test demonstrates a method for analyzing and evaluating a range of frictions, accounting ratios, and other commercial data to enable the candidate to the commercial data to enable the candidate to assess the potential risk and returns of applications and to make preliminary recommendations on whether or not to advance funds. So it helps you out on the basis of the different methods, on the basis of the different commercial data, that means the numerical data provided by the accounts department, to whether invest in that particular project or not, whether that investment will help you out to earn more than the expected returns or not, whether the potential risk is going to be worthful or not, right? Because we all know that the resource finance is very limited and it has to be accumulated, and then we have to plan a lot before we distribute or we invest. So that is why the financial appraisals becomes very important perspective to understand. The main purpose of the financial appraisal is the justification that the returns will exceed the estimated construction cost of the project. So what happens is that to invest in a particular project or to build a new company or to even start a new venture, a new financial project, you have lots and lots of costs involved. So what does financial appraisal do? It actually helps you out to evaluate all the cost which you are going to incur so that you can have that investment versus the estimated expected returns you are going to earn from that project. And you compare both of them. If you are earning more in comparison to the cost invested, that means the project is good, you can invest and you can earn the money. But if they both are equal, the decisions will be indifferent. The manager has to decide. And if the cost is more than the return, then definitely no one should invest in such types of avenues, because they are totally giving you that clear picture that it is going to sink all the cost which all the returns which you are going to expect, and it is just a loss proposal, not a win-win situation. So financial appraisals help you out to take these decisions by comparing all the cost versus all the returns. Through this procedure, the investment capital or the resource required for the construction of the project can be estimated. after assumptions about the utility and the benefits of the assets have been determined. In the construction industry, the problem of deciding the amount of investment and allocation of resources to the project is actually the capital budgeting process or the problem. So what happens is that we have just taken one of the industries to understand the construction industry. So you have to, decide that whether to invest or whether to start that mini project or not. And that is done on the basis of the evaluation of your cost and the returns and then doing it. And this evaluation process is actually what is your capital budgeting. So somewhere down the line, now you know the definition of the capital budgeting, that it helps you out to evaluate the investment opportunities, that whether to invest in that particular area or not. The benefits from the project are estimated, and then the client or the investors can estimate budget which is necessary for the completion of the project and decide if he would proceed with the construction of the project or abandon it. So then the evaluation process takes place. So first and the foremost step is to first write down all the estimated cost, all the estimated budgets are prepared. And then later on the estimated returns or the benefits you might be earning it in, let's say, 10 years or 5 years, whatever the time zone you are planning out to do the project. And then compare the both, whether the benefits are more or costs are more. If benefits are more, go. Just construct the project and go ahead. It's a green signal. But if the cost is more, then abandon it right now. The best way to save your money is to stop it at this very moment. Because in future, this investment avenue or this construction of the project will not help you out to earn the money the way you are predicting. So it is like a first initial stage to tell you or give you the clear picture that whether you will be earning money in future or not, whether you are in that right path to earn money or not, whether your investments are in the safe place or not. So this is how the financial appraisals through the capital budgeting helps you out to evaluate the financial projects. Now the question must come is that, let's suppose we have two projects, project A and project B, and both of them are giving you more of benefits. Let's take an example to understand. Like, let us just assume that you have project A and we have project B, right? Project A is also giving you benefits, project B is also giving you benefits. But the project A is giving you only 1 lakh more benefit in comparison to the project B, which is giving you 1,50,000. So definitely the project which gives you more of benefits should be selected. So if let's take an example that you had three plans, that is A, B, C, in which the C1 was actually giving you lots of cost in comparison to the benefit, so it is already eliminated. Now you are left with the two plans, that is A and B, and then select the one which is giving you more the benefits. And this is how in practical life also you take the helps of these budgeting, capital budgeting, and decide. The same way when you go into a canteen and you decide that what to eat when you have, let's say, 500 rupees with you, right? What permutation combinations are to be taken into the consideration so that you have the maximum benefits, right? So that is what you are doing. You are also there at that moment, calculating that, okay, if I order a pizza, that these are the things. If I order the chow mein, this is all what I'm going to get. This is the cost and this is the item, and I might not be able to fulfill my hunger. So all that analysis of cost versus your benefits is your capital budgeting, and it is a part of your financial appraisals. So the another point which we have to discuss right now is that the financial appraisals, which act as the above mentioned as a decision making tool for the client or investors, depends on two of the most very important aspects. The first aspect is the size of the potential construction project. What is the size of that construction? Is it a small scale, medium scale, large scale? Because the size will increase the cost, and then the revenues will also be increased, but the initial fund required to start that particular project, the cost will require huge amount of money. So the first and the foremost factor which helps you out to take the decisions in the capital budgeting is the size of the potential construction project. Then come the time period over which the cost and benefits are going to be calculated. For how long you are going to evaluate the project, right? This is a very tricky part to analyze, that how long you feel that the project will give you the earnings or will be a profitable business. Will it be 5 year calculation, 10 year, 15 years, 20 years? That time zone calculation is also very important, and these two factors, that means your size of the project and the time, are very critical decisions to be taken by the financial manager. And these two things becomes a very important factors when we do the calculation also, because in calculation you will take the time into the consideration, and that time has to be decided right now, that whether that factory which I'm starting will help me out or will be with me for 5 years or for 10 years or for 20 years, right? So that decision will be a very valuable decision, so you have to think very carefully that the end, that number of years for which your investments are going to be. So that is also one of the very important thing to be taken into consideration when we talk about the financial appraisal. Now, why do we need to do the financial appraisal? What are the importance of financial appraisal? So the first importance is that it ensures that the project is available to get reasonable returns on investment made to carry on sustainable operations. So what happens is that to calculate the returns, you need to take the help of the financial appraisals, because this is one of the methods which help you out to analyze the returns which you will be coming up in the future, right? And this is how we decide. There are n numbers of methods in which you do the financial appraisal. The first one which we will discuss is your payback period, right? In which that how many years will be there the money invested, or how soon you will earn back all the money which is invested by you in that project. So that is also one of the way to calculate the sustainable operations of that particular project. So one of the importance is that it ensures that the project is available to get the reasonable returns on the investment made by the carry on the sustainable operations. Then it helps you out to estimate the cash flows and reasonable level of operations that the unit can make it from its operation. So you need to first analyze the returns, the cash flows which are you going to earn, that profitable level that you will be earning from the operations or from the investments or from the construction of that particular project. So financial appraisals actually helps you out to estimate all that returns, all that profits pre-hand, so that you have the data with you for the future comparison also. But let's take an example that we are right now in 2025, and we are going to invest 1 crore rupees, and we have understood and analyzed that our project will be for 2030. That means for 5 years, right? So in this method, you will be actually calculating all the profits, that is your EBIT or your net cash inflows for all the years. That means for even 2025, 26, 27, 28, 29, and then for your 30. And then let's suppose in 2027 you have earned 1 lakh and you estimated 1 lakh. That means you are going as per your plan. But let's suppose you earned only 50,000. right? But your estimation was 1 lakh. That means that you are going to compare, you will try to compare and analyze that deviation. You will have some standards, you will have some calculation with you to compare your work which you'll be doing in the upcoming future. So financial appraisal even help you in that perspective as well. Then comes, it estimates the cost of the projects and the sources of the finance, their respective cost and the cost of capitals of the completion of the project. So this financial appraisal is not about only to evaluate the future profits. It is also about related with the how much of the cost is going to be there. Let's take an example. Let's continue this example itself, this 1 crore one, that you need to invest 1 crore. So from where you're going to get this 1 crore? Either you are going to raise the new equity, or you are going to start up your new preference share, or you will raise the money with the debentures, or you are going and applying for a bank loan, or you have some amount retained with you. What source of fund you will be choosing, that will also be a part, a very crucial part to check the cost, because we have learned in the cost of capital that each source of fund have their own associated cost, right? We have learned how to calculate the KD, KE, KP, KL, KR. So that cost has to be also analyzed. Then let's take an example that 1 crore factory is not being started or not, constructed, but we are buying a 1 crore machinery. So that machinery import duty, that is also part of the cost. That machinery's installation, that machinery require the training of the people who are there in your organization right now. So that training cost also become a part of your overall cost of the project. So you have to analyze the cost which is associated till the use of the project. The moment you start using that project, till that point, all the costs should be analyzed, should be sum up, should be calculated, so that you can then compare it with the future profits and take the corrective action. That means whether to invest or to abandon the project. And that is why we say that the financial appraisal process is not helping you out to just estimate that whether to invest it or not, but it is giving you the answer of many other things. The total cost, how much you require, from where you're going to get that money, at what rate you might be needing that money, at year one, how much you might are projecting to earn, year two, how much you will be earning, at year five, how much you are projecting to earn, at which level of your timeline you will be recovering all the cost which is there, right? We will learn the PBP methods, but I'm just giving you that hint that how to use this financial appraisal and all the calculation associated makes this concept really very important for us to understand. And these are the practically used perspectives, these are the practical use topics which are there, and every organization uses it. Even you at your home use these financial appraisal. Why not? When you have to decide that whether to give a party at the home or in some cafe, that is what, that is the appraisal of a project. Whether to have or organize a party at home in your own room, or you will go out and relax with your friends in a cafe, right? You will analyze the cost, you will analyze the comfortable area for both the zones for all the friends, and then you will decide what to do and what not to do. What is that all calculation? That all calculation becomes a part of your financial appraisal. And if you do it for an organization, they will help you out to take decisions regarding that, and it will be known as the corporate financial appraisal, and the method used will be a part of your capital budgeting. So you already know what is capital budgeting and what is financial appraisal. But we have to just understand these small nitty-gritty, combine all those mini thoughts, and then sum up from the point of view of an organization and then solve the questions. Because this concept is well known, you are doing it from very beginning. But now we have to just do it in a very proper format, with a proper schedule, with proper formulas, with the different methods. And this is how you will learn the capital budgeting process. We have n numbers of methods. You will learn, you will compare the methods as well. You will learn the advantages and disadvantages of the different methods, right? So now let's not waste the time and continue with the importance. The another important perspective which your financial appraisal gives you out, that it helps you to deal with the various liquidity and capital structure ratios. You will learn it when we do the methods, but yes, it helps you out to calculate the various liquidity ratios, and it will help you out to construct that capital structure, that ratio of your all the different sources, your ke, kd, kp and all that, all capital structure ratios and all will also be taken into consideration, and financial appraisal will help you out to do this calculation as well. Then it determines the break even point to find the exact level of sales and production when the units can be break even, right? So it helps you out to even calculate the break even point. We will learn it how to do it, but right now the major importance of the financial project are in front of you. Just take a minute and just read all the points. Just pause my video right now and just read the points by yourself so that you have the clear picture of all the importance associated with the financial appraisal. So now let us just have the look on the investment decision, which is also known as the capital budgeting. So the word investment refers to the expenses or the expenditure which is required to be made in connection with the acquisition of the development, by which the management select those investment proposals which are worthwhile for investing funds. It might be a bit confusing one, but this definition of investment is the perfect definition to understand all the aspects related with this term investment. So what they are trying to tell you, that the investment refers to the expenses or the expenditure which you are going to do so that you can acquire or develop a investment proposal which will help you out to earn more of money, right? So this is what investment. Now the important definition which we should know and we should learn is this capital budgeting. So capital budgeting is the process of evaluating and selecting a long term investment proposals that are consistent with the goals of shareholders, that means the owners, wealth maximization. So this process of your capital budgeting helps you out again in what? In maximizing the wealth of the shareholders. See how beautifully all the aspects, all the topics which we are studying are getting connected with our main objective of financial management, that is wealth maximization, right? So what is capital budgeting? It is a process relating the long term investment. The characteristic is that this is done for the long term investment of the capital or the money which will help you out to earn lots and lots of profits in future, right? And this capital investment proposal when studied is known as your capital budgeting. Future profitability, the word which we have used, means the inflows of profit and the reduction in the costs, right? So this is very important for you to understand that what is investment, first of all, that the investment decision is also known as the capital budgeting decisions. Then you should know the definition of the capital budgeting. You should know that it helps you to achieve the goal, that is the shareholders wealth maximization. And then what do you mean by the future profitability? So the capital budgeting decisions are taken on a long-term assets, that means that which are there with you for more than 1 year, and which yield returns. That means returns means cash inflow, the profits inflow. Money is coming in. That means returns, cash inflow over a period of time. That means the end, that life of that project, but involves investments, that means the cash outflow, the cost, the initial cost at the present. So what you're doing over here is actually you're going to assess long term asset in which you will first calculate cash inflows of different years and calculate the cash outflow, which is also known as the initial investment, and then compare the both and decide whether to invest or not. And this is what? This is capital budgeting. So first of all, at this point, now you should know that what we need to know, we need to know all the cash inflows, that means the profits, the time period, and the initial investment or cash outflow. So what is capital expenditure? So capital expenditure is using of funds that is expected to produce profit or benefits over a period of time exceeding more than 1 year. So the time is always going to be more than 1 year because we are doing this study for the long term assets. So thus, capital budgeting is the total process of generating, evaluating, selecting, executing, and follow up of capital expenditure alternatives. So all the alternatives which you have plan 1, 2, 3, or A, B, C, you take the care of all those. You analyze their, cost, you analyze their investments, you analyze their returns, you analyze the time period, and then decide on that basis that which one is to be pegged or which combination should be pegged, right? So this is what? This is the definition of the capital budgeting. So now let's just have a look on the features of capital budgeting. Capital budgeting involves high risk, right? Why high risk? Number one, a huge amount of capitals are invested. Number two, n number of years. That means it's a long-term project. Number three, we calculate the profits which we are expecting in future, expected profits in future. And as we say future, number four, future is uncertain. And number five, uncertainty brings up the risk. That's why capital budgeting involves lots and lots of risk. Large profits are estimated. Definitely, if you are investing more, the returns are also going to be high. And we know the golden rule, higher the risk, higher the return. So that is why we are going to expect or estimate large number of profits. And the last feature is that long-term period between the initial investment and the estimated returns. So this is also one of the very important thing to be taken into the consideration. That means the N, the number of periods which you are there with you for the entire calculation. Because there are probability that you estimate that the project will run for 10 years, but maybe future was not there with you. The circumstances or the external factors were not as per the calculation, and the time period of 10 in reality got reduced to 5. So you are going to incur lots and lots of loss as per your calculation. So that is why it is important for us to calculate that long-term period, that is N, and it has to be very specific or near to the specific so that you can, get the exact results which you are actually expecting. So the needs of capital investment or the capital budgeting, we have discussed the importance. Let us just see that why do we need. So the factors that need gives the rise to understand the capital investment is that expansion, diversification, obligances, wear and tear of the old equipment, productivity improvement, learning curve effect, product improvement, replacement, and modification. So these are the areas because of which we do a huge investments and we need to do the calculation of capital investing. Maybe you want to start up your new brand. You were there with the brand A, now you want your brand B. Expansion. So for that brand B, you will be doing the entire calculation that what all cost will be incurred, how many years you need to, work hard to get that point where you can recover your break even point will be there, and then later on the profits should be earned. So that point or that tenure, the calculation of that particular brand B is one of the areas for which you do the capital investment. Then the diversification, you want to diverse your market. Maybe before your diversification, you were just limited to your India, but now you want to expand and you want to be the market leader of the Asian. So you want to expand, or you want to diversify your exports. So that is why you need to do the capital investments, that whether it will be feasible to do the exports to the other Asian neighboring countries of India. That means whether the product will be accepted in the Pakistan, whether the product will be expected in Jammu, sorry, your Sri Lanka, your Bangladesh, your Myanmar, your Nepal, your China. So whether to export it or not to export it, right? And if to export it, how to export it, how that diversification will be taken, how your production line has to be increased. First and foremost thing, that if you're going to increase your doors, then means that you need to have lots and lots of products with you, and for that you need to increase the capacity of your production houses. For that you need to again have a huge investment in the new machineries. You might need to have one more plant for that production, and that will be again a part to do the capital investment decisions, right? So diversification becomes one of the need to do the capital investment. Obsolescence, that means your machineries are getting outdated, it is not as per the new technology, it is obsolete, you have to take the new one. So which new one, which new company has to be chosen, which machinery has to be taken, because in technology also you have n numbers of options. So which one to choose, which one not to choose, that will also help you out to do the capital decision. Then wear and tear of old equipments. Maybe the old machinery is not working the way you were expecting, and it is getting obsolete. So whether to continue with that old machinery, or it is the right time to get a new one, or whether to just have a new improvement, that means to attach a new machinery part which help you out to get the life extended, right? There are new many a time the situation in which you don't buy the entire new machinery, you just buy a new part of that machinery which helps you to increase the efficiency, maybe a new engine, or maybe a new body part of that machinery which increases the efficiency. So whether to do that or whether to buy a new one, that also required the decisions which fall under the category of your capital investment. Then the firm value will increase the investments that are profitable. So it helps you out to increase the profitability if your firm's value also increases. So your proposals involve the longer gesture period, sustainable capital outlay, technological consideration, irreversible decisions, environmental issues, and many more. Right? Significance, they are very significant because it involves the capital rationing decision. It helps you out to control the devices, like expenditure controls. You come to know that how much expenses are under your calculation, and how to go ahead with that calculation itself. Then it helps you out to even manage the funds from where you need to get the money so that you can start your new venture. Then it helps you out to deal the right evaluation of that project, how to deal with the right mind. That means that I have selected this project, so what I'm expecting, my rate of returns, right? So all that significant, all that small points, these 5 points helps you out to do the proper capital budgeting or the proper investment analysis. And it becomes very important for us to evaluate the project very correctly, because each and every factor have a good impact on the entire decision. If the n is changed from 9 to 10, the decisions will change. If your inflow is changed from 10% to 12%, your decisions will change. If your outflow increases or decreases, your decisions changes. So just pause this video right now and go through all the significance which is there right now on your screen. I have explained them right now. We had a discussion on these significance, but just read it, because in examination, direct question comes that what is capital budgeting and what are the significance of capital budgeting, and it can be a 4 marks or 6 marks directly. So just pause the video right now and have a look on the significance of capital budgeting. So now let us just discuss the process of capital budgeting. It is really very important for us to know that how that capital budgeting take place. What is the process? So the first step is project generation, followed by project evaluation. Then you select the project and then you execute the project. So we will just understand the each step one by one. The first one is project generation. In this, you actually take the different projects into the consideration. You try to add up the different proposals you have, and then from those proposals you come up and collect all the data which you require, right? Maybe you want to start a new business, right? So we have, let's take an example, three options, right? So the first one is to acquire running business. The second one is to be the partnership with someone. And third one is to be a sole proprietor, right? To start from scratch by ourselves and we will be the only owners, right? So you have to first generate all the three projects, in which you will be writing all the costs, all the profitability situations which are there for you. So project generation means to design all the perspectives or all the alternatives which you have with you, right? Then comes your project evaluation. Now, what you will do in each of these project A, B, and C, you will evaluate. What you will evaluate? You will evaluate the cost versus benefit metrics, and then you will take the decisions in the third step. But right now, you will just evaluate all the benefits, all the costs, and what all costs will be there in the project A, what all costs will be there in project B, what all costs will be there in project C, then the benefits of A, B, C respectively. On these basis, you will take the major decisions in the step 3 and 4. So first one, to evaluate the alternatives. The second one is to the first one is to generate the alternatives. Second one is to evaluate the alternatives. That means to calculate the estimated benefits and cost, and then to select the one. And the selection will not be uniform. See, there are n numbers of methods. Just to give you a brief idea, we have PBP method, we have NPV method, we have IRR, right? We have ACC method also. We have n numbers of methods, right? These are the few common ones which I have stated right now. Now, each of this will give you the different answers. There might be probability that in your PBP, it says to go with the option A, but IRR is saying to be with B, and AC is saying it to be C, and NPV is saying it to be with A. So you have to actually decide that which method you are going to select and which is relevant for you, and then on that basis you will select the project. It can be a combination of two or more and any of them, and the selection will take place on the basis of your answers which you will get from the calculation of your point 2. And then fourth one is the final one, that whatever project you have selected, maybe A, B, or C, or let's take A, then you will just implement it, you will execute it, and then you will just keep on checking that whether you are working as per the budgets you have prepared it or not. So this is the process of your capital budgeting, that is project generation, evaluation, selection, and execution. These are the steps. I'll request you to just pause the videos and just go through these slides, because they are very theoretical part, and I have explained you in the nutshell what are these topics all about. Now, the very important and another topic which I want to discuss with you right now in this video lecture itself is the kinds of decisions we take in the capital budget. There are various types of decisions which we take on the basis of the evaluations of the cost and revenue. So let us just first understand the decisions which we have. We basically take three types of decision. One is accept or reject. Then we have mutually exclusive project decisions, and then we have capital rationing decision. So let us just first of all, learn these three important decisions one by one. The first one is your accept or reject. So what happens is that when you do the calculation, maybe with the help of the PBP or the NPV, you can directly come up with the conclusion whether to accept the project or reject the project, right? So these types of decision in which you directly decide whether to accept or reject is your accept or reject decision. Let's take an example that you have a project X in which your cost is approximately 50,000 and your estimated future profits for summit of cumulative one profits future profits for, let's say, 10 years is coming up to be, let's say, 50. And when you do the present value calculation, because this is for the future values, right? So you need to calculate it at the present, right? You need to bring that money at the present values to compare it, to have the common base. Otherwise you cannot compare it. We have studied this concept in time value of money, so I request you to go back to the time value of money to and learn that how do we calculate the present value if we have the future values. So to bring that one, let's take an example that we are getting it approximately, roughly, let's say, 60,000. Okay. This is just a rough estimation that the amount is coming 60,000. So of course the project will be accepted, right? Why? Because your cost is less and your cumulative inflows, that means the profit at the present value for the all the expected 10 years is 60,000. So you are in a win-win position of 10,000, right? So that means that you will accept the project, and definitely you will reject if that this amount is not 60, it would have been 40. You will reject the project because the value is our profit is less and the cost is more. So this is one of the decision whether to accept it or to reject the project. The second category is your mutually exclusive project decisions. So now what happens in mutually exclusive is that if you opt A, the second one automatically gets, eliminated from your project plan. Let's take an example that you have two options. The one is to buy a new machinery. The another one is to repair repair the old machinery itself. Right? So if you are opting for any of these, the another one is automatically getting rejected. This is mutually exclusive project. So if you are opting to have a new one, that means you are going to automatically exclude the repairing of the old one. You will not be repairing it because you have automatically accepted the one, to the another one gets rejected. Or if you have selected the repairing the old machinery and continuing it with, you may be just adding a new motor or new engine, and then just adding some lubricants, getting it greased up, just doing it some mechanical thing and getting it worky. So that means that you are okay with the old machinery. So why to buy the new one? Why you want to get the new one if you are just repairing the old one and ready to go with it? So these are your mutually exclusive project decisions. Then come rational decisions. The capital rational decisions are those decisions which are generally there with us, and they are there with you because of the limitations of fund. So let us just take an example. You have four plans, and the four plans have, let's take a cost of 10, 20, 30. 40, right? So now what happens is that you cannot select any of them randomly, or you cannot select any two, any three, or the combinations just the way you want it. Definitely I would like to go with all the four and earn lots and lots of money, but that is practically not possible. Why it is not possible? Because we all have money constraint, right? We have limited money with us. That means we have capital rationing. So what happens is that the top management gives you out the budget. That okay, we have a budget of, let's say, 40,000, right? So till 40,000, whatever you want to do, just do it. You want to opt for two projects, three projects, but our budget is 40. So what you can do, either you can go with this D itself solely, or you can go with the combo of C and A, or you can go with the combo of your A and B, and you can save the money as well, right? So this different combinations, just because of the capital constraint, is what is your capital rationing decision. So decisions which you are taking because of the investment limitation, the amount of investment limitation, and the various combination which you might be, selecting and rejecting, is because of the capital limitations or the capital rationing you have from the top management or from your institution, is going to give you the decisions related to the capital rationing decisions, right? And you try to get in that ascending or descending order on the basis of the cost or on the basis of your profitability. So there are different ways which you will learn, but right now you just know that the three ways in which the capital budgeting decisions are taken is your accept or reject, mutually exclusive, and your capital rationing decision. So so in this today's video lecture, we have actually learned lots and lots of things, but they were all important for us to understand before we go ahead with the calculations of the different method. So we have understood what is financial appraisal, what do you mean by the capital budgeting or the investment decisions. Then we looked on the features, the needs, the significance, the process, the kinds of decision, the three kinds of the decisions which we take. So now just let's have a quick recap of all what we have studied with the help of this quick revision test with the help of MCQs. And we will just then later on check how many of you get 10 on 10 and evaluate your progress. So the first two questions are on your screen. Select the correct answer as per the learning and understanding which you have developed from this video lecture. So the first two questions are on your screen. Question number 3 and question number 4. Question number 5 and question number 6. Question number 7 and question number 8. Question number 9 and question number 10. The last two MCQs of this video lecture. So let's just check the correct answers of all the questions. And the correct answers are in front of you. The question number 1 and question number 2, the correct option is option A. For question number 3, the correct option is option C. For question 4, the correct option is option B. For question 5 and 6, the correct option is option D. Question 7, the correct option is option A. Question 8, the correct option is option D. Question 9, the correct answer is B. And for question number 10 also, the correct answer is option D. So I do hope that you have scored good score out of 10 in this MCQ test and have understood the basic concepts of what is capital budgeting, the different decisions, the process, the significance, and the needs of the capital budgeting. So let's just wind up this video lecture, and thank you all for watching this video lecture. Happy learning.